Hey there, everyone, and welcome to The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com, not from Redmond, Washington this week, but indeed from New York City. We've had a lot of great conversations here in the city so far, focused on the resilience of the technology trade. Today, we have NVIDIA and Oracle both moving higher, regaining some of their losses that they registered at the end of last week. We'll also talk about some of the weaker charts out there. Airlines like Southwest, Boeing, and others gapping to the downside. With that all in mind, let's get right to our market recap. Before we bring up the charts, I do want to answer a poll question. We asked you recently, what will the S&P 500's total return be in 2024? Put on your crystal ball or take a look at your crystal ball and think about where we're at now. Interesting to note that the S&P and the Nasdaq up about, 8.5%, 9%, depending on where we're at going into the close here. So 61% of you said that's just the beginning. We're going to finish the year over 10% higher from the end of last year. 27% of you said single-digit returns, which means almost 9 out of 10 respondents in our poll said we would be in the green for 2024, which leaves only a brave 12% of you. The bears in the group suggesting we go below there. You know, it's interesting. I probably would say over 10%, but I think it's not going to be a straight line. And I think if we've learned anything here from the last 72 market hours going back through Monday and then Friday and Thursday of last week, it's a volatile period. There will be a lot of transitional sort of moves. While we've had certainly an unrelenting uptrend led by the mega cap growth stock so far in 2024, it's actually quite unusual. And I think we're seeing a lot of the signs from sectors like industrials, financials, healthcare, really starting to show some renewed strength here in March so far. Maybe this is part of a larger leadership rotation. We think it is, but today, for what it's worth, sort of a mean reversion from that pullback. Tech on top. Rates going a little bit higher as bonds are coming down. Precious metals coming off a little bit, volatility coming down. So all those themes we talked about on Friday, all sort of rotating right back to where we started here on Tuesday, March 12th. All right, so let's continue our market recap. Looking at the major market averages, how they've evolved here on a Tuesday afternoon. The S&P 500 up just over 1%, 1.1% higher, closing just about 51.75. The Nasdaq Composite outperforming up over 1.5% today. The Dow Jones lagging behind those first two, up 0.6%. Notice how small caps are actually down slightly, down about 0.3%. The S&P 600 finished just above 1,300. That's been a major theme here so far in 2024. Been large over mid over small, and bit of a change to that dynamic here in the last couple of weeks as small caps have started to break out. Again, today we're getting back to sort of one of the key themes of 2024, which is large over mid over small actually losing a little ground today. The VIX pushing back below 15, and that was one of those things we talked about at the end of the week going into Monday. The VIX pushing above 15. I had a number of alerts set as I was flying out from Seattle yesterday. My phone is dinging with the VIX pushing above 15, which is a noteworthy level because as I would think, given the recent range of the VIX pushing above 15 is sort of a high volatility environment, or at least not a low volatility environment anymore. Sort of telling you that things are changing a little bit. For now, it looks like we're right back to the VIX below 15, which is a low volatility bullish phase. That's been the story for much of 2024. Seems like we're going to remain there for a little bit longer. Bond prices actually moving lower today. You can see the 10, 5, and 30-year points all drifting higher as bond prices move lower. The 10-year yield finished today around 4.16, almost the identical level of the 5-year yield, and the 30-year point, the long bond yield, just about 4.3%. Of course, the short end of the curve is still fairly elevated. We had the latest CPI number that came out earlier today, a little higher. I mean, honestly, basically in line with expectation, still well above that 2% bogey that the Fed has talked about for so long. So, basically what's happened is we have more of a risk-on move with stocks going higher, bonds coming off, growth stocks doing just fine, value stocks lagging behind a little bit. And I would say in a lot of ways, that's a reaction to this CPI number basically coming in as expected. And had there been a big upside surprise where inflation was way higher than normal, I could see the markets maybe selling off, because that would imply the Fed would have to wait a lot longer. But, for now with the interest rates where they're at, with inflation where it's at, still remaining above that 2% bogey the Fed has talked about, certainly seems like first rate cut sort of pushed down the road a little bit. As we've been talking about, I think this basically means no change to that theme. Less rate cuts in 2024 and probably starting a little bit later. Dollar index, no real change from Monday's close. Precious metals moving lower. You can see the GLD, the SLV, both down over 1%, about 1.1, 1.2%. Energy prices overall moving lower. Crude oil prices about 1/3% lower. And continuing on to cryptos, all red, but you can see from the little preview chart to the left over the weekend, Bitcoin almost got up to 73,000. We're continuing to tease all-time highs. Bitcoin and Ethereum prices overall very much in a position of strength. With Ether, we were talking not too long ago about whether it would get above 2,000. I distinctly remember talking about that on the show and thinking about the importance of getting above those big round numbers like 2K and 3K. Well, here we are with 4,000 basically briefly eclipsed over the last 24 hours. We bounced lower to around 38 and a quarter, and now bouncing higher. We're just below that 4,000 level here. So cryptocurrencies overall have been a resounding bullish story here in recent months. We're going to do a segment later in today's show we have not done in quite some time called Crypto Corner, where we're going to focus on cryptocurrencies. We'll look at the chart of Bitcoin, talk about the difference between, looking for a top, trying to anticipate a top versus trend following, just following the trends as they go higher. We'll show the chart of Bitcoin, get into a little more detail here in a few moments. Looking at the 11 S&P sectors, you can see it was technology and then everything else. The tech sector, XLK, up just over 2%. Communication services and consumer discretionary, both up about 0.9%. 4 of the S&P sectors finished in the red, and the more defensive sectors of utilities and real estate leading the way lower. Utes were down almost 1%. Real estate down 0.25%. Energy is just slightly below the zero line. Looking at the Magnificent Seven and Friends, this, group of less and less related growth and mega cap growth names. But overall, I still think a really important group to pay attention to. NVIDIA, nice rebound after losing quite a bit on Friday with that bearish engulfing pattern that we've highlighted on our own YouTube channel and elsewhere, bouncing back higher. NVIDIA actually finished strong, up over 7% today. Meta and Microsoft both up about 3% for the day. Tesla was the only one of this group of names actually finishing in the red, just slightly below zero. Apple and Alphabet both up less than 1%. Let's go to a daily chart of the S&P 500, just checking on how things played out through the course of the day. Now, what's interesting is as we talk about trend line support becoming trend line resistance, I feel less and less comfortable and confident about this trend line that I've drawn, because what's happened is we're no longer really tracking this trend particularly well. You might want to redraw this line at a lower level, and I'll show you what I mean by that. The idea with trend line analysis a lot of times is, a trend that you define with a trend line, it sort of works until it doesn't. And what I mean is this was that initial trend line off of the October and early December lows. We broke that in late December and pulled back in this consolidation phase that really lasted into the third week of January. Then we broke out of that level, sort of took the new support and drew from the October low to the January low, projected that forward. Now we've sort of been chopping below that. I'm wondering if, it might be too early to draw this, but I'm wondering if this is the new trend line, kind of taking, I don't need an arrow on that, kind of taking the most recent level. So here's the October low, sort of the mid-February. Now the March lows are all kind of lining up. I don't know if I feel great about that line just yet, but I'm going to leave it on here for now just so I don't forget that I drew it. It's worth noting when the trend changes to draw a trend line to sort of recognize the new level. What I would say, though, as I'm getting into the annotations and updating this chart, I like to think when there's a particular trend in the market, I think for this case, thinking of the uptrend in the S&P 500, the uptrend is there, right? We know that we're going higher because we keep making higher highs and higher lows. And even with the choppiness we've experienced here in the last couple sessions, the trend is still up as defined by the Charles Dow theory of higher highs and higher lows. What I like to do is draw a line in the sand, right? What's that level that when we break it, you basically confirm to yourself, no matter what else I think, I'm going to revisit this sort of long position or this sort of bullish sentiment, because at the very least, we've broken through a key level of support. 50-50 is that level for me. That's that horizontal purple line that I've drawn here. It's a level we've highlighted really since this breakout. This was actually the early February high. We broke out in mid-February and then retested that level a couple times. I think the S&P over 50-50 is a pretty good chart. And that's an update. That's a level we've updated, right? The level back here was 4,700. That was the floor here. We sort of got away from there. And as the market goes higher, you sort of bump up that line in the sand to sort of lock in, paper gains, essentially, right? We're sort of moving that threshold higher and higher as we keep making higher lows. But I would say that's the most recent significant low. That's a pivot point because it's been resistance and support. And for now, of course, with a day like today, S&P moving up over 1%, 50-50, very much not in play today. That's where I have an alert set on the Stockcharts technical alerts. I would encourage you to do the same and let a platform like Stockcharts do some of the work for you. Now, I can't help but notice as we're looking at the S&P making higher highs in early March, that it's doing so on weaker momentum. Now, this has been an issue we've talked about for quite some time, right? The S&P making new highs on lower RSI, the QQQ, a very similar pattern of new all-time highs on weaker momentum. That sort of bearish divergence is one of my initial checks on the checklist of a bull market top. I think we're sort of doing it. By the way, I'm probably going to do a webcast next Tuesday where we announce and update our bull market checklist and reflect on what conditions we're observing here in mid-March. I'll have a sign up for you tomorrow on the show, and I'll let you know how to sign up for that free event coming up next Tuesday. All right, with that in mind, let's keep going and look at some of the other sort of big picture charts. As I'm looking at the Mindful Investor Live chart list, again, any of the breadth indicators that I would highlight for you are all quite bullish, right? They're sort of similar to previous bull market phases, not at the bull market exhaustion level, but more in a healthy bull market level. And something like the Bullish Percent Index is looking at the percent of stocks in the S&P 500 with a bullish point and figure profile, currently finishing the day around 72%. That means 72% of the S&P members are in a bullish point and figure profile. That breaks below 70%. That's your sell signal. We did get that in mid-January. It did not play out particularly well. The market continued higher. You'll see previous sell signals that we highlight on the chart worked very, very well as we had a meaningful pullback afterwards. So I'll continue to monitor that. For now, the bullish percent index on the S&P 500, back up in the bullish range. The bullish percent index on the Nasdaq 100 very noticeably is down at 58%. So there's your gap between growth stocks and more value-oriented stocks, where the Nasdaq 100, obviously a very growthy index of leading names, the bullish percent index has gotten lower and lower. This is part of that leadership rotation we've talked about. I think is very much still in play here in mid-March. One of the things to observe is on the market recap. One of the things we've not seen is an improvement in defensive sectors. You saw today the XLU, the XLRE, utilities and real estate were at the bottom of the list today. One of the things that I would point out that we highlighted on one of our shows last week was, to really think that the market is at a major top. You have things like bearish divergence, which usually happen a little early. You can also look for rotation, and I think we have seen a rotation, but it's not growth and offense into defense. We're not seeing that sort of performance from defense. It's more rotational from growth leadership to value leadership, sectors like industrials and financials. I think we're still in the midst of that rotation. Today's move aside, I think, looking for opportunities in things like financials and healthcare and industrials makes a lot of sense. If you missed our episode on Friday, I sat down with Grace and Rose. We talked about our top 10 charts to watch for March 2024. A number of value stocks that were highlighted there in some of those sectors that I just mentioned, particularly healthcare, where you tended to find quite a few number of ideas. But what you're not seeing, which would be very much a red flag for this market, would be an improvement in the relative strength of defensive sectors. That's utilities and real estate and consumer staples. For now, those are actually, hanging in with the market okay, but really not outperforming in any significant way. And again, that's one of the things I might want to look for. NVIDIA continuing to return to a bit of an offensive move, right? We had Friday's bearish engulfing pattern, Monday drifting a little bit lower, getting below 850 today. Reclaiming about 50% of the losses that we experienced since Friday's open. NVIDIA finished just below 920. That's up about 7%. And again, NVIDIA going higher. All eyes on NVIDIA. I feel like so much has been talked about with this particular stock, and I think it's not just about NVIDIA. There are a lot of other semiconductor names that have a similar pattern. A lot of other mega cap growth names that I think are worth following as well. But if you're going to follow one stock besides the S&P and the Nasdaq, NVIDIA is probably it, as long as it keep making higher lows, which if today's tells you that this was a higher low that we just experienced on Monday, that's still a pretty bullish chart. IBM's another one too. If you look at stocks that are not necessarily overextended but moving higher, IBM, not really registering NVIDIA type of numbers so far in 2024, but having a pretty decent go of things. Finished the year around 160. We're actually up to almost $200 a share, not quite getting above there. But look at this nice basing pattern that we experienced after the gap higher in mid-January, finding support just below 180 and now rotating higher. We made a new 52-week high today, and again, but a clear higher low that we experienced in February. I think that's pretty encouraging. Now, it's not all good as we wrap up our market recap. There are things going lower, and I would encourage you to pay attention to our scanning engine. Make sure you have alerts set up on stocks that you own, ETFs that you have in a portfolio, because the alert platform basically tells you when something has been triggered. Southwest gapping lower today. There's news related to Boeing, which has also been one of the worst performers in the S&P here, given all of the news surrounding the company. But today, with the gap lower, Southwest finished lower by almost 15%. That gap's well below this trend line, making the recent lows, which seemed like a pretty good trend line until today. Today's gap also pushed us below the 200-day moving average. And again, as I was taught, nothing good happens below the 200-day. So a chart like Southwest, I think of as pretty much broken until and unless we can get back above that 200-day moving average. Note the bearish momentum divergence that occurred going into today's action. It's another reason to pay attention to some of those leading indicators in the technical toolkit. That's it for our market recap. Again, a lot of things on the move. Tesla, we didn't have a chance to get to, but I'd encourage you to pay attention to that one as well. I do want to remind you, we have our mailbag always open. We're hoping to do a mailbag episode here very soon. We'd love to answer one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on X @finalbarsctv, and we're on YouTube. Just drop a comment below the video you're watching here on our YouTube channel. We would love to hear from you. Hope to answer one of your questions in our next mailbag show. Want to continue on with our next segment called Crypto Corner. We're having a blast going through some of the old segments we used to do on the Final Bar. Back in years past, we had a number of segments that we worked up, a number that we haven't revisited in quite some time, and it's been fun thinking about how we can revisit some of these themes. I want to talk about cryptocurrencies. As we mentioned in our market recap, the story for cryptocurrencies have been remarkably strong, right? Bitcoin, teasing 73,000, Ethereum prices teasing 4,000, briefly going above there in the last 24 hours. These are incredible levels when you think about where we were not too long ago, right? A year ago, and think about where we're at. I mean, even months ago, and the move that we've had. What's interesting is from a fundamental perspective, for lack of a better term, when you think about things like cryptocurrencies, there is limited fundamental data. Now, there are some things you can sort of try and back into if you want to get a sense of upside potential for Bitcoin. Some of the things that we've been highlighting recently, outside of technical analysis, number one would be all the Bitcoin ETFs that have been released. And since, think about the last 12 months and what has occurred, really the last 3 months and what really has occurred. November, December of last year, we're speculating as to when those Bitcoin ETFs would be approved. That's sort of here, and you can see where the Bitcoin ETFs were approved because there's initial sell-off. This is a classic buy the rumor, sell the news, and that is a well-worn market maxim. When a rumor is there, that's when the optimism tends to, blossom, right? Investors get more and more optimistic because of an anticipation of this news event actually playing out. By the time the ETFs actually were released, it ended up leading to some short-term distribution. And I would argue part of that is probably just a lot of rotation around cryptocurrencies and, where investors were placing their bets. Now that you have a lot more levers that you can pull if you want exposure to Bitcoin. Also, just the fact that anyone that bought earlier and was really excited sitting on some paper gains sort of expects a pullback after those ETFs are finally announced. But if you look what happened after there, we put in a meaningful low just below 40,000 for Bitcoin. And from there, it's been lights out, moved to the upside. Bitcoin's almost doubled from that point. Gaining ground from around 39,000 to closing today around 71,000, as I mentioned briefly above 72,000. So we have now eclipsed those previous all-time highs, which are on the left side of the chart there toward the end of 2021. Down here at 16,000, it seemed like an impossible goal to return and regain all of those losses. It has now been done. So now the cryptocurrencies are in a clear bullish phase as defined by a pattern of higher highs and higher lows. what's next, right? What would we anticipate as the next objective? So two ways you can think of something like Bitcoin or Ethereum or any of the cryptocurrencies we don't have time to get into, but I think you can apply this methodology to a lot of cryptos because they look in a lot of ways similar to the charts we're showing here. I really only pay attention regularly to those two, Bitcoin and Ether prices, because they're pretty widely followed. I often get asked about them for media outlets. So option number one, when something is making new highs, is you can project what the next new high may be. So there's a whole set of technical tools that have you basically look at what has happened previously and use that to anticipate what levels may become important down the road. I've switched to our ACP platform, our advanced charting platform. One of the questions I actually noticed in our mailbag, I have not answered it yet on the air, but I did notice the question come in was, just thinking about when to use sharp charts versus when to use ACP, the advanced charting platform. We actually do have two very powerful charting platforms running simultaneously on Stockcharts. When do I actually use both of them? When do you use one versus the other? So what I would tell you is overall, I think the long-term vision for Stockcharts is more and more we'll find less differentiation between the two because our Sharp Charts platform is getting a complete ground-up redesign using and taking advantage of some of the more recent developments in web-based visualizations that should allow us to apply some of these capabilities in the advanced charting platform into our all of our charts. So I think our Sharp Charts will continue to look more and more dynamic over time. But the ACP platform really is a dynamic platform. It is designed to allow you to left click and drag to stretch x-axes and y-axes to really manipulate the charts real time. So if I was a swing trader primarily, if I was a day trader and I was using the Sharp Charts platform, if I really wanted to think about different time frames and how the short-term to long-term compared very quickly, I would be using ACP probably all of the time. If you want to get a sense of how more of a medium-term, long-term investor uses the ACP platform, watch Joe Rabel's show on Stockcharts TV. He does a great job. He uses ACP primarily. What I like about what he does is he has charts like this, but he'll have 4 or 5 of them going at once, and then he'll zoom in and out at each one of those. And that's something that I use when I really want to think about multiple time frames on a particular stock. What I love about our normal Sharp Charts is they look really good if you want to export them out of the Stockcharts platform. I would say that Sharp Charts is essentially an image, right? And so when you're bringing up a chart, when you're adding annotations, all it's doing is creating a series of images. And what that means is if you copy and paste this into a document, into a presentation, into an email, into social media, it's going to look exactly how you see it here. And you can set the pixel count and do some really cool things to make this chart look beautiful outside of Stockcharts. And that's why I use Sharp Charts very heavily, because I'm often sharing things on social media, putting things into a PowerPoint presentation, sharing them out on YouTube and doing things like that. And so Sharp Charts is a little better for that. So I would encourage you to explore both of those, by the way, to answer your question from the mailbag. So getting back to Bitcoin, how can we project a potential next high? So what I've done is apply the Fibonacci retracements, and I've taken the low from November of 22, the all-time high around 70,000 and 69,000 and change from the fourth quarter of 2021. And you can see these levels between the two. And I just wanted to notice this was a great test of the 61.8% level here in January before we pulled back and then finally broke above there. That's why that break above 50,000 was so important. We talked about it back during that period, the beginning of the year, was the importance of that 61.8% level, how that lined up with that April 22 high, and why that was a reasonable point to expect a pullback and why the breakout was so meaningful. But what we can now do is drag the chart down, and you can see I've done what are called Fibonacci projections. And I have a couple different ways that are sort of well documented on how to do this. I've done probably the most simple method, which I often find the best option because it's easiest to do. And what I've done is basically said, here is 100% of a retracement back to the November 21 highs. What about 138%? What about 162%? And I can project that to a 200% retracement and so on. You can see that a 138% retracement, which basically means 38% above the previous all-time high, and you can see, of course, we've broken above that. It means if we do make meaningful gains above 70,000, your upside objective is 90,000. And what I like about that is it's also right around a big round number, 90K. And as we've well covered on the show here, big round numbers like 20,000, 30,000, 50,000, etc. have often been important for Bitcoin. You've often seen major returns around those big round numbers, and that's why I think it's an important one to look at going forward. So potential upside target of 90,000, given a confirmed break above the previous all-time highs, I think could be an important method. So option number one, you project higher, right? You use some method thinking about the movements, and you project them higher. Another thing we did back here was take the height of patterns, right? So this is the pattern from sort of mid 23 to late 23. If you take the height of that pattern and project it higher, that gave some of these upside targets around 40,000 plus, which is where we reached in the fourth quarter of last year. So Fibonacci retracements, and on our platform, you want to use ACP to do that. It has a lot more flexibility in terms of what's Fibonacci levels we're using and what objectives we want to identify on the upside. The other thing that you can do is just go with old classic trend following. And I would tell you that when you're looking at something like Bitcoin making new all-time highs, we can either project the next high or we can use trend following mechanisms. And what that means is you're basically saying, all right, I know that Bitcoin is going higher. Now I just want some sort of alert when we're not going higher anymore, right? I want some sort of confirmation that we're breaking down. Now I have a series of moving averages that I've thrown on here. Given how quickly Bitcoin has accelerated, this is something that I'd like to use on something that's really started to move higher very quickly. I've added the 21-day exponential moving average. Grayson Rose, I think, often uses the 20-day EMA, if I remember right. But I think it's either that or the 21-day. And this is one that I've occasionally throw on the charts. And I usually don't have it on here. I do very much have it on there when something is accelerated, because an exponential moving average is very reactive. So when a market goes vertical, the simple moving averages will get further and further away from the price. You can see here's the 50-day moving average all the way down around 52,500. The 200-day, forget about it. It's all the way down at 40,000, which means we'd have to lose 30,000 points here to get down to that 200-day moving average. So using more sensitive moving averages can be helpful, because that can be a good early warning sign. Again, not that I would manage money based purely on this one moving average, but a break of the 21-day EMA can be a good early warning that whatever was happening leading up to that move, that breakdown is telling you at least something is different. So the 21-day moving average, EMA, by the way, that I have on the chart here, is right around 63,000. That's about 10% below current levels, as we're sitting just below 71,000. So it would be a significant drop from previous highs. But given the volatility in something like Bitcoin, not too unreasonable given the trajectory that we've seen so far. So to wrap up Crypto Corner, make sure you use the ACP platform. I would use two different sort of techniques, one to project a potential high, the other one to use trend following techniques like a lagging moving average, just as a way to anticipate a top, but also confirm that a top may have occurred. With that in mind, folks, let's wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. Home Depot is one of my standard example charts. I love thinking about this particular stock. It's a good liquid stock. It's in the consumer discretionary sector. It just is a good sort of general example. The reason why I want to highlight Home Depot is similar to IBM, similar to NVIDIA, and many of the other stocks that we've talked about. It's in an uptrend, and I think that's important to remember. I've had so many questions about, especially after Friday's bearish engulfing patterns, is that the top? Should we be short? Like, how should we be playing this? And what I always try to remind people is you have to separate different time frames, right? Think about the tactical time frame. I think that's where something like a bearish engulfing pattern really comes into play. It tells you that there is a short-term distribution pattern, but it is still a short-term pattern. More of the medium-term and long-term trends are defined by things like higher highs and higher lows. And Home Depot making a higher low, it appears, as of a Monday's close. Bit of a sort of a hammer candle, certainly a doji candle before we bounced higher today. And then also things like the 50-day moving average. Don't forget to just stick with basic trend following mechanisms in a market that is so strong, right? Let the chart tell you when the trend is maybe changing. We were recently overbought, so we've had a bit of a pullback. As long as we keep making higher lows in an uptrend, the overall trend in the chart is positive. Here's chart number 2, and I actually want to bring up a candle chart of Tesla. We've talked about Tesla and other leading growth names, the Magnificent Seven. I'm going to still note on my pages to come up with a better moniker than Magnificent Seven, because I think the Magnificent Seven is sort of diversifying enough. You probably want to have a new label for those leading growth names, but it's worth noting probably, this almost looked like a hammer candle earlier. I probably call this a doji candle more than anything. But if you look at what's happened with Tesla in the short term, is we've stalled out a little bit, right? Here in early March, we gapped lower, had a couple down closes, you can see by these solid candles, and then we sort of treaded water. We sort of held our ground for a little bit. So right now we have a series of lows right around the same point. We're very much in the same range as the early February low, which was a hammer candle right there before we rallied for the next couple weeks. We're getting a short-term reversal candle on Tesla as well, which makes me think today's low, maybe that's your downside threshold. You expect a bit of a short-term bounce. Remember, candles work both ways. So in an uptrend, look for bearish candle patterns like we saw on NVIDIA on Friday. Also look for bullish candles when something is pulled back a little bit, and look for opportunities where something is turning higher. Our third chart to highlight for you is looking at the performance gap between large caps and small caps. Here we have the S&P 500 and the Nasdaq 100 year-to-date returns in the 8 to 9% range. These were down in the low sevens until today's bounce, but overall, obviously a nice start to the year, given all the uncertainty at the end of last year. Questions about this bull market off the October low. Questions have been answered, and overall, first 10 weeks of the year, for the most part, been pretty strong, but small caps certainly lagging behind. It's interesting when you think about this market and the extended run that it's had, you look for weakness in leading names. So you look for weakness in things like NVIDIA and Meta. You also look for strength in areas of the markets that have been lagging behind. Now, we've seen small caps improve to a degree, and they're actually in the positive year to date, which is a nice improvement, but still pretty big gap, about 600 basis points plus from small caps to large caps. I wouldn't be surprised if that performance gap starts to narrow, and that could be with a combination of things. I think it's probably a little bit both, where small caps continue to improve, led by sectors like financials and others that are bigger weights in small caps than large, and also maybe a bit of more of a pullback in growth names. But for today, that pullback not continuing to be large over small. That's the story for 2024. All right, that'll do it for today's show. Thanks so much for joining us every weekday after the close for the final bar from New York. I'm Dave Keller here at Stockcharts.com. Be well, stay safe, have a good night.